fiscal dominance would be less inflationary if it imploded the private sector. So, for example, by raising rates so quickly, they blew out interest expense, but they also killed some of the banks. But when those banks started to fail, instead of letting deposits that are uninsured go bust, they bail out the deposits. And so they kind of soften what happens on the private sector while putting the gas on the public side, and that's where you get fiscal dominance being more inflationary. So it could include things like SLR rules changes, kind of financial jargon that helps banks hold more treasuries, which is also basically what they did in the 1940s. It wasn't just the Fed monetizing all the treasuries; it was other pools of capital, including banks, and banks. Because they have fractional reserve, policies, that they can hold quite a bit of treasuries depending on regulations around them.
In today's ever-changing global economic landscape, one voice stands out as a beacon of insight and foresight: Lyn Alden. With her keen understanding of macroeconomic trends and market dynamics, Alden is renowned for her ability to navigate turbulent financial waters and uncover opportunities amidst uncertainty. Alden's insightful research identifies safe haven assets like gold and Bitcoin as strong contenders for outperformance as liquidity circumstances rapidly change around the world. Alden is quite passionate about Bitcoin and believes it will reach at least $100,000 in the next 18 months, anticipating even greater price spikes before the cycle ends. Alden recently shared her thoughts in an exclusive interview with Blockworks Macro, co-hosted by Gromen. She examined the macroeconomic conditions in the US now and predicted another era of high inflation by drawing comparisons to the decades of the 1970s and 1940s. According to Alden, inflation will continue to be obstinate and difficult to control, just as in the past. As we bring you parts from this insightful discussion, where Alden clarifies the nuances of the current economic environment and provides priceless insights for investors navigating the market's difficulties. So let's hear what she has to say.
And I've pointed out in some of my newsletters the concerns people had in the 80s and early 90s around the debt levels. So, for example, the famous debt clock went up in 1988 or 89, and then Ross Perot ran the most successful independent presidential campaign in the early 90s, largely based on debt and deficit. That was kind of a main issue of his, and so that was like peak zeitgeist of that this matters. And if you look at the chart of interest expense as a percentage of GDP, that was peak interest expense, because even though federal debt was still fairly low, they had ultra high interest rates, and therefore they had they looked like they had a spiral starting. Now, they had the fall of the Soviet Union, they had the opening up of China to the world, and then they had this kind of 30-year stretch of major globalization, interest rates falling from double digits all the way down to basically zero. And so, if I were to describe the fiscal problem in one kind of frame, it would be, we've had 40 years of rising debt to GDP, but it's been offset by 40 years of falling interest rates until we hit zero. And so if we just go, sideways now, let alone up, but if we just go sideways now, then we no longer have that offset of interest rates compared to the debt. And a lot of this is locked in, and now we're well over, like 100% debt to GDP. And so I think it's almost ironic. I think basically because so many people freaked out in the 80s and 90s around the debt and deficit, that they, like a lot of analysts then say, okay, that's kind of like they were way too premature. The lessons we learned is that debts and deficits don't matter. That's how a lot of people took that. Pendulum has swung so far that now people are in the mindset that debts and deficits don't really matter, and it's starting to matter. And so, for example, we've had the longest period of the Conference Board leading indicator being like in recession territory, and yet not having an official declared recession. We've had, PMIs went down. Normally bond yields go down when that happens. Instead, bond yields went up. And as Luke pointed out, that chart, gold and real rates diverging. The fact that the Federal Reserve had to come in and stop reducing their balance sheet in 2019 while there's still an economic expansion. These are all kind of things that start happening, and it's not like one Boolean outcome, like we go from not in fiscal dominance to permanently in fiscal dominance. But over the past, call it 5 years, there's been a number of pretty clear indicators that various signs of fiscal dominance and EM-like characteristics in the U.S. are building. And so I don't think it's a matter of like, okay, here, like 2028 is like the, date that we're going to enter fiscal dominance. My view is basically ever since 2019 or so, we've roughly been flirting with it. that's fiscal is now a bigger factor than it normally is, and we don't have that 40-year offset in lower interest rates to offset that. And if somehow, let's say if AI comes and just completely gives us this massive disinflationary force and just kind of holds down, they're able to have low interest rates despite fairly high money supply growth. Well, then I still want to be in kind of the same assets that I'm in anyway, which I'd rather be in gold and Bitcoin than treasury bonds, for example, in that environment. Fiscal dominance would be less inflationary if it imploded the private sector. So, for example, by raising rates so quickly, they blew out interest expense, but they also killed some of the banks. But when those banks started to fail, instead of letting deposits that are uninsured go bust, they bail out the deposits. And so they kind of soften what happens on the private sector while putting the gas on the public side. And that's where you get, fiscal dominance being more inflationary. So it could include things like SLR rules changes, kind of, financial jargon that helps banks hold more treasuries, which is also basically what they did in the 1940s. It wasn't just the Fed monetizing all the treasuries. It was other pools of capital, including banks. And banks, because they have fractional reserve, policies, that they can hold quite a bit of treasuries depending on regulations around them, especially if those treasuries are shorter term.
Over the past 3 years, inflation has been a major problem, especially during the epidemic. In response, central banks dramatically increased the money supply, a move that many financial experts said would have disastrous consequences. The U.S. Federal Reserve and other central banks continued to issue warnings as interest rates started to rise in 2022. Alden, a famous macroeconomist, disagrees with central banks' optimism that the worst of inflation is behind us. She contends that this might be the start of a decade of inflation. Alden claims that central banks are ill-equipped to deal with this problem. Here are some more extracts from the interview for further insights.
I think we're going to have higher highs and higher lows of inflation than we had in the prior decade. That's how I would describe a secular inflation. And kind of a major thing I've been pointing out is, questions I got over the past couple years were, are they going to get inflation back down to 2%? And my answer has generally been, I don't know, but I don't think that's the right question. I think the right question is, what's going to happen with inflation the next time we have an upcycle in PMIs, for example, like Manufacturing Purchasing Managers Index, because I think that's the real test. You can get inflation down temporarily if you're willing to have a recession, if you're willing to disinflate enough, and that's kind of the pseudo cycle we've been on. It's obviously been offset by fiscal, as we've been talking about. So they've not gotten it down to 2%, but they have muted it significantly. We're starting to see early signs of PMI reacceleration, kind of rotation in what sectors are doing well. And so I think the big test is, if we get an upcycle in PMI, what does inflation do? My expectation is that inflation goes up or stays sticky when we get that next PMI rise. And so it's not a matter of, could they touch 2% sometime this decade? Sure. But the question is, can you sustain there and having like another cycle of growth while still sustaining there? And I think that's the much harder thing. And so, because I think this is going to be a more energy intensive cycle, I think we're going to be more linked to what happens with energy than we have been in say the prior 10 years or so. And so I think my expectations, higher highs and higher lows compared to what we had in say the 2010s decade. I think the funny thing is that because we're kind of largely in fiscal dominance now, I think that the emphasis on the Fed is in many cases like backward looking, that the Fed has been a bigger source for markets for a long time. But as we kind of enter this fiscal dominant environment, I'm increasingly less interested in what the Fed does around the basis point margin, and more interested in what's happening with the treasury market, more interested in what's happening with the size of fiscal deficits, and those kind of more structural things. So to the extent that the Fed, cuts rates a little bit, or if they even add some interest rate hikes to it, it's not really the answer in my view. I think basically that the large structural fiscal deficits are a bigger factor. And ironically, if they try to get down inflation by increasing interest rates, they're going to blow out the fiscal deficit even more. And so that's the lever that's different from the 70s, but closer to the 40s. And so for me, it's looking at, what are tax receipts going to be like? So for example, now because 2023 assets were pretty good, asset prices, we should expect decent tax receipts here, which ironically could narrow the deficit a little bit, which could give us, kind of a somewhat weaker performance in 2024 for at least some of these, like, say, mega cap assets. I think those factors matter more. I think also we've seen, for example, some of the treasury decisions to shorten the average duration of their treasuries have had bigger effects on the market than what the Fed does in a given meeting. So some of these quarterly treasury releases have been bigger factors than the Fed. Obviously, during kind of acute liquidity things, like, for example, the early 2023 banking issue, that was both a treasury and Fed issue together. But in general, I think that overall liquidity, overall fiscal is actually a bigger force than the Fed. So I don't really have a firm view. Let's say a -3 cuts or plus a couple hikes. That range is largely irrelevant for my investment decisions. Obviously, if we were to get major moves outside of that range, I would start to care again. But as long as expectations or my expectations are fairly somewhere in the middle, I think that's not the biggest lever to be focused on compared to what's happening in fiscal, compared to what's happening in, say, supply and demand of oil. Those, I think, are the bigger forces.
According to Lyn Alden, we are probably going to go through a persistent inflationary phase with higher highs and higher lows than we did in the previous 10 years. She emphasizes the significance of comprehending inflation dynamics in relation to how inflation acts during economic upswings, such as rises in the Purchasing Managers' Index, PMI, rather than solely in terms of hitting a certain objective like 2%. Alden notes that although fiscal stimulus programs have allowed central banks to somewhat control inflation, the next PMI increase will be the true litmus test. In such times of economic prosperity, she predicts that inflation would either increase or stay stubbornly high. According to Alden, the emphasis on actions taken by central banks, including changing interest rates, may not be appropriate given the present fiscally driven climate. Rather, she highlights the role that structural elements like fiscal deficits and fiscal policy have in determining economic results. Alden also cautions against putting too much faith on central bank actions to bring down an inflation, as doing so might make fiscal deficits worse. She draws a comparison between the state of affairs now and the 1940s, when fiscal policy dominated economic management. In terms of investment decisions, Alden suggests that factors like fiscal policy, oil supply and demand dynamics, and treasury market decisions may have a more significant impact than short-term central bank actions. As such, she prioritizes monitoring these broader economic indicators over reacting to minor fluctuations in central bank policy. Until next time, happy investing.